Okay, today we're going to talk about credit and why personally I don't think it's that big of a deal to have a mortgage professional pull your credit. That is usually one of the first things when I talk to people. They trying to get pre-approved for a house. They say, "Oh, are you going to pull my credit? Is it a hard pull?" And because they're worried about it, I often go into this explanation. And so I thought, why not just put the explanation out there and let you know why me, as a mortgage professional, I don't think it's that big of a deal to have your credit pulled. And there's lots of reasons why, but just in general, I wanted to talk through a few things, and the only way that I thought I could do it really the best is to actually show you what it looks like from a credit score from 350 to 850, right? So there's lots of ranges in there, but I drew a little chart here, and I just want to cover kind of where we're starting from, and then we'll get into some of the details about why it's not a big deal to have your credit report pulled. Okay, so starting off, credit reports range from 850 all the way down to 300. So with that, you can see between 740 and 850 is actually the best scores. The reason I say that is that a 740 is every bit as good as an 850 when it comes to mortgages. Now, other industries I'm not talking about, that may be a big deal somewhere else, but in general, for mortgages, a 740 is going to be the threshold that you want to cross if you're looking at financing for the purpose of an interest rate. Now, while I say that, not all loan programs have any concern for the credit score. And I shouldn't say any concern, but there's something called risk-based pricing. Risk-based pricing is for loans that are dependent on the credit score relative to your interest rate, right? So government loans like VA, USDA, FHA, are not nearly as price sensitive, risk sensitive as are conventional loans, conforming loan limits, so non-jumbo type things. You have the ability to look at within the range where the scores fall. So back to my little chart here, 740 to 850 is the best you can do. The highest you need to qualify for a mortgage and get the best interest rate is going to be 740. The reason why it's 740 is that Fannie Mae and Freddie Mac have something called loan level price adjustments. Loan level price adjustments assess the risk of the loan, and relative to credit score, there's no penalty, there's no benefit for a score over 740. There's only decrements for scores under 740. So let's take a look at those real quick. 740 is the highest you need for the best rate. And then you've got a range between like 680 and 740. And they go in basically 20-point increments. With those 20-point increments, if you had, like for instance, if you had, let me get it in the camera there. Okay, so if you had a 719 versus a 721, you would cross the threshold of 720, and the interest rate that you receive might be slightly better, might be the exact same, or the cost of that interest rate might be slightly worse if you had the 719 versus the 721. But in general, you've got those thresholds, the 680, 700, 720, and 740, that if you cross, it makes a difference. But just so that you know, a 721 is every bit as good as a 739. So when people are fearful of having their credit score pulled, their credit reports pulled, then there's a possibility that they may have like a 2 or 3 point change in one or more of the bureaus. Again, you would have to cross over that threshold to make a difference. So in my opinion, it doesn't make much of a difference at all relative to that risk-based pricing and the actual interest rate that you'll receive. Now, what is important, if you drop down under that 680 mark, that's where you're going to get into scores that are somewhere between the 679 down to 300. And FYI, I don't know anybody that does loans down at the 540 range. Guild is one of the few people that I know that has a plan for 540 credit scores. And just to let you know, they're difficult, so I don't promote that a whole lot. But in general, when you start getting under that 680 score, we're going to start looking more towards some of the government programs, might be better interest rates, better qualification. But just so that you know, most of the USDA, FHA, VA, the down payment assistance programs are going to fall into that 660, 640, 620 range. And then 600 to 540, Guild does them. There may be other people that do them as well, just not real sure. But under 540, I don't know that you can qualify for a traditional conventional loan unless it's maybe hard money or something. And I don't think even that's going to be much of a play. So the reason why I show you this is to let you know that for people who have scores under 680, that FHA loan might be the best loan program for them. So we would want to look at that. Naturally, if we can go conventional, there's benefits of doing that as well. But in general, those FHA, USDA, VA loans are not rate sensitive. So for us, if you cross the threshold for qualification, then it doesn't matter. You're qualified, right? Anything higher than that doesn't really matter. That's not true on conventional financing, where the higher the score, the better the rate likely would be, or at least lower the cost for that rate. So what I tell people is, I can't tell you how to improve your situation if I don't actually pull your credit. So pulling your credit with Guild, at least, will do a couple of things. One, it will tell you exactly where you're at from a mortgage grade credit standpoint. There are lots of scoring models, lots of FICO scores, lots of versions of FICO, and the mortgage industry, we all use the same one, right? So that way, if you're a bank or a credit union or a mortgage company, then you know that your credit's going to be pulled with a mortgage grade credit report. And that's so important because it's very different, can be very different from that which would be, a Credit Karma or myfreecreditreport.com. The data that they're pulling from those reports is all the same. But the scoring model, the algorithms and the output of the score is going to be different. So the mortgage industry uses a very old, very stable, very secure, very conservative scoring model, the FICO scoring model. Even though you may get from your credit card, my FICO score is, yes, it is your FICO score, Fair Isaac score, but it may not be a mortgage grade credit report, which is what we in the mortgage industry all use to satisfy Fannie and Freddie when we sell the loans on the secondary market. So if you have questions, give me a call. Having your credit checked is not that big a deal. And by the way, when I pull your credit, I'm going to go ahead and we're going to be able to tell you what you can do to improve your score by paying down things, switching things around. So we'll look at and evaluate it with you. And there are means by which you can legitimately improve your score, not boost it for a day. We can actually help you improve your score so that you get qualified for the loan you're looking for. Andrew McElyea, Guild Mortgage, please give me a call if I can be of assistance. We are happy to help, and we look forward to seeing you on the next one. Bye-bye.